Hello everyone, welcome back to my YouTube channel. Today's update brings you the latest developments surrounding the Vietnamese dong and the USD VND exchange rate. As always, we focus on verified financial information, economic trends, and what these developments may mean for Vietnam's economy, international trade, and currency watchers around the world. If you enjoy factual and professional financial updates, make sure you stay with us until the very end, because today's report provides an important look at how the Vietnamese dong has been performing in recent weeks and what the latest exchange rate movement may be signaling. The latest figures show that the USD VND exchange rate declined to 26,290 Vietnamese dong per US dollar on June 29, 2026. This represents a modest decline of 0.04% compared to the previous trading session. While the movement appears relatively small, even minor fluctuations in foreign exchange markets often reflect broader economic forces operating behind the scenes. Currency markets rarely move randomly. Every adjustment reflects changes in investor sentiment, trade activity, central bank policy expectations, capital flows, inflation outlooks, and global financial conditions. Today's movement indicates that the Vietnamese dong has gained slightly against the US dollar. When fewer Vietnamese dong are required to purchase $1 US, economists describe this as a strengthening or appreciation of the domestic currency. Although the percentage change is relatively small, it contributes to a broader picture of currency stability that has characterized much of Vietnam's exchange rate management over recent years. Looking beyond today's movement provides even more useful context. During the past month, the Vietnamese dong has strengthened approximately 0.12% against the US dollar. While this gain is not dramatic, it demonstrates that the currency has gradually recovered some ground despite continuing uncertainty across global financial markets. Stable monthly performance is often viewed positively because businesses value predictability when planning imports, exports, investments, and long-term contracts. However, when examining the longer-term picture over the past 12 months, the Vietnamese dong remains approximately 0.65% weaker than it was 1 year ago. This annual comparison highlights an important reality of currency markets. Exchange rates rarely move in a straight line. Instead, they respond continuously to changing economic conditions, both domestically and internationally. A currency may strengthen over 1 month while still showing depreciation over a longer annual period. Several factors help explain why the Vietnamese dong continues to demonstrate resilience despite global economic uncertainty. Vietnam remains one of Asia's fastest-growing manufacturing and export-oriented economies. Strong production activity, expanding industrial capacity, and continued foreign direct investment have provided important support for the country's external financial position. International manufacturers continue viewing Vietnam as a strategic production base due to its skilled workforce, competitive labor costs, improving infrastructure, and extensive network of international trade agreements. These structural advantages have encouraged multinational corporations to expand manufacturing operations throughout Vietnam, supporting demand for the local currency through investment inflows. Exports continue to represent one of the strongest pillars supporting Vietnam's economy. Electronics, machinery, textiles, footwear, furniture, agricultural products, and seafood remain among the country's leading export categories. Strong export earnings generate foreign currency inflows while supporting domestic employment, industrial production, and overall economic growth. Foreign direct investment also remains a significant contributor to Vietnam's economic momentum. New manufacturing facilities, logistics centers, technology parks, and industrial developments require substantial capital investment. These long-term investments reflect confidence in Vietnam's economic fundamentals and often provide additional stability for the country's financial markets. At the same time, Vietnam's authorities continue emphasizing prudent monetary management. Exchange rate stability remains an important objective because excessive currency volatility can create uncertainty for businesses, investors, and consumers. By maintaining orderly market conditions, policymakers seek to balance export competitiveness with price stability and investor confidence. Inflation also plays a significant role in determining currency performance. Moderate inflation generally supports purchasing power and helps maintain confidence in a country's monetary system. If inflation remains under control, central banks have greater flexibility when implementing monetary policy while preserving financial stability. Global developments remain equally important for understanding today's exchange rate movement. The US dollar continues responding to expectations regarding American economic growth, inflation, labor market conditions, and monetary policy decisions. Whenever investors reassess expectations surrounding US interest rates, currencies around the world often experience corresponding adjustments. If expectations grow that US interest rates may eventually decline, the dollar can weaken against numerous international currencies. Conversely, expectations of higher interest rates may strengthen the dollar by attracting international capital seeking higher investment returns. These global financial dynamics frequently influence emerging market currencies, including the Vietnamese dong. Trade flows represent another major influence on exchange rates. Vietnam imports substantial quantities of industrial machinery, raw materials, energy products, and technological equipment needed to support manufacturing and infrastructure development. Meanwhile, exports generate foreign currency earnings that help finance these imports. Maintaining a healthy balance between export revenues and import expenditures contributes to overall exchange rate stability. Financial markets also closely monitor global commodity prices because changes in energy, metals, and agricultural commodities affect production costs throughout Vietnam's economy. Lower import costs can reduce inflationary pressures while supporting business profitability and consumer purchasing power. Investor confidence continues serving as another important factor influencing currency performance. International investors evaluate political stability, economic reforms, fiscal discipline, legal frameworks, and long-term growth prospects before allocating capital. Vietnam has generally maintained a reputation for macroeconomic stability, which helps attract investment despite periodic volatility in international markets. Many analysts note that Vietnam has successfully diversified its export destinations over recent years. Rather than depending heavily on a single trading partner, Vietnamese businesses export products to numerous international markets across North America, Europe, Asia, and other regions. Diversification reduces vulnerability to economic slowdowns, affecting individual countries, while supporting more balanced trade performance. Technology manufacturing continues expanding rapidly throughout Vietnam. Global demand for electronics, semiconductors, consumer devices, and advanced manufacturing products has encouraged additional investment in Vietnamese industrial zones. These developments strengthen export capacity while creating skilled employment opportunities across the country. Tourism recovery also contributes to foreign currency earnings. International visitors spend money on hotels, restaurants, transportation, entertainment, and retail purchases, generating valuable foreign exchange inflows. Continued recovery in tourism supports service sector growth while strengthening broader economic activity. Domestic consumer demand has likewise remained relatively resilient. Household spending supports retail businesses, manufacturing output, and employment. Balanced domestic demand complements export-driven growth by creating multiple sources of economic momentum. Banking sector stability represents another positive factor supporting confidence in Vietnam's financial system. Healthy banking institutions facilitate lending, investment, business expansion, and consumer spending while maintaining financial stability during periods of international uncertainty. Government investment in transportation infrastructure, ports, highways, airports, and logistics facilities continues improving Vietnam's long-term competitiveness. Efficient infrastructure lowers transportation costs, enhances supply chain efficiency, and attracts additional industrial investment from international companies. Educational investment and workforce development further strengthen Vietnam's long-term economic outlook. A growing supply of skilled workers supports higher value manufacturing and technological innovation, allowing the economy to move gradually toward more advanced industries. Although today's exchange rate movement appears modest, professional investors understand that gradual trends often carry greater significance than dramatic daily fluctuations. A one-day movement of 0.04% does not necessarily indicate a major shift in economic fundamentals. Instead, it reflects the continuous process through which financial markets incorporate new information into asset prices. Businesses engaged in international trade often welcome periods of relative exchange rate stability because predictable currency values simplify financial planning. Exporters can estimate future revenues more accurately, while importers face less uncertainty regarding purchasing costs. For Vietnamese consumers, a stronger domestic currency may modestly reduce the cost of imported goods, including electronics, machinery, certain food products, and industrial materials. However, exchange rate movements represent only one factor influencing retail prices, alongside transportation costs, taxes, supply chain conditions, and overall market demand. Export-oriented businesses may view currency appreciation differently. A stronger domestic currency can make exports slightly more expensive in foreign markets, potentially affecting price competitiveness. However, Vietnam's export success